This Chapter 4 illustrates the application of Moody's scoring approach to Walmart and to Macy's to derive their estimated credit rating, emphasizing the contrast between them and explaining why their credit ratings lie so far apart to assist you absorb the key learning points as applied to real companies. Our choice of these two companies is based on their enormous brand recognition and street visibility, which should mean that their business model and history are relatively familiar to many listeners. Nonetheless, we will shortly provide a summary of the key aspects of their business and operations before delving more closely into their financials. Throughout this chapter, we base our calculations on each company's annual report for 2010 on Form 10-K, a link to which is provided in the course outline as mentioned before. We note in passing that both companies' fiscal year ends in January, so the data available in these Forms 10-K is normally dated as of the end of January 2011. Walmart is the world's largest retailer with almost 9,000 retail units located in 28 countries, ranging from Canada and the United States to South Africa and Brazil, and has annual sales of around $420 billion in 2010 and more than 2 million so-called associates, a term that means something close to employees, worldwide. Walmart began operations in 1962 and its stock trades on the New York Stock Exchange. Approximately $260 billion in 2010 sales came from the regular U.S. stores, which have 3,800 units in total. Another $110 billion came from Walmart International, which boasts another 4,500 units. And the remaining $50 billion or so was delivered by Sam's Club, a membership system that entitles members to discounts and other privileges in exchange for an annual membership fee, and which has 600 units. The company's growth since it began operations has been nothing short of spectacular, although some problems surfaced in the past couple of years with regard to its pricing approach, requiring a change in policy and a re-emphasis on the policy known as Everyday Low Prices, or EDLP. The company is also seeking to expand its global e-commerce division, whose goals are described to include 1. The development and execution of a global e-commerce strategy, 2. The acceleration of growth for the global online channel, and 3. The creation of technology platforms and applications for every Walmart market. Macy's, another retailer of considerable fame, is quite different in a number of ways from Walmart. Macy's was established as far back as 1858, but has reached a total of only 810 stores in aggregate, including the 400 stores or so it gained as part of the acquisition of the May Company a few years ago. Macy's also owns Bloomingdale's, the upscale department store that focuses heavily on contemporary fashions and brands, including Armani, Chanel, and Jimmy Choo, among many others. Aggregate annual sales for Macy's as a whole, however, reached only $25 billion in 2010, which makes Walmart larger by 16 times on this particular measure. Macy's is almost exclusively based in the United States, although it has entered a license agreement with an operator in Dubai, which opened the first store in February 2010. With this brief introduction out of the way, we now provide the relevant financial and other data extracted principally from the two companies' 10-Ks that we will use in applying the Moody's methodology to determine the likely credit rating for these companies. What you see now is a table that shows side by side the key financial figures for the two companies, each of which you should have no difficulty verifying in their 10-Ks. From the respective income statements, we have extracted for Walmart and Macy's respectively $420 billion and $25 billion in revenues for the fiscal year, $7.6 billion and $115 billion respectively of depreciation and amortization expenses, of which amortization alone is zero for Walmart and $41 million for Macy's. $2 billion and $574 million respectively in net interest expenses, $7.58 billion and $473 million respectively in income taxes paid, and finally $16.4 billion versus $847 million in net income after tax. From the respective statement of cash flows, we have extracted for the year ended January 2011 net cash provided by operating activities of $23.6 billion and $1.5 billion respectively, cash dividends paid of $4.4 billion and $84 million respectively, and finally common share repurchases in that year worth another astonishing $14.8 billion for Walmart versus zero for Macy's. While there can be some debate on this question, and in contrast to what we did in our module on restaurant industry analysis, we will not treat the Walmart share repurchase as equivalent to a cash dividend, given how unlikely it is that such a high rate of share repurchases could be sustained going forward. From the balance sheets, finally, we have extracted the following averages by adding the beginning and ending figures for the year and dividing by 2, all of which we will need in the calculation of average book capitalization when we come to the efficiency subfactor in a moment. Average book equity and minority interests of $71.9 billion and $5.1 billion respectively. Average long and short-term debt adjusted for operating leases of $61.6 billion and $10.06 billion respectively. Average deferred income taxes of $6.1 billion and $1.2 billion respectively. And average cash and cash equivalents of $7.65 billion and $1.2 billion respectively. These combine together to produce average book capitalization of $132 billion and $14.76 billion respectively. Finally, we have extracted from the financials of each company rental expenses under operating lease agreements amounting to around $2 billion and $250 million respectively for the most recent year. In regard to this last item, we remind you of the 3 important analytical adjustments Moody's makes here. First, it multiplies the operating lease annual payments by a factor of 8 to derive the debt equivalent amount, specifically $16 billion for Walmart and $2 billion for Macy's, which it adds to the balance sheet both as an asset and a liability. Second, it decomposes this annual payment into a 1/3 component which it regards as interest and a 2/3 component which it regards as depreciation. And third, it adjusts the statement of cash flows by reclassifying the principal quote-unquote portion of lease payments from operating cash flow to a financing cash flow. The consequences of these adjustments are the following. First, for Walmart, the $45.6 billion of on-balance sheet debt is increased by the $16 billion figure to become $61.6 billion on a lease-adjusted basis. For Macy's, the $8.06 billion of on-balance sheet debt is increased by the $2 billion figure to become $10.06 billion of lease-adjusted debt. Second, for Walmart, net interest expense of $2 billion is increased by 1/3 of the $2 billion of operating lease payments to become $2.667 billion on a lease-adjusted basis. For Macy's, net interest expense of $574 million is increased by 1/3 of the $250 million of operating lease payments to become $657.3 million on a lease-adjusted basis. Third, for Walmart, depreciation and amortization of $7.64 billion is increased by 2/3 of the $2 billion of operating lease payments to become $8.97 billion on a lease-adjusted basis. For Macy's, depreciation and amortization of $1.15 billion is increased again by 2/3 of the $250 million of operating lease payments to become $1.317 billion lease-adjusted. Fourth, for Walmart, operating cash flow of $23.6 billion is increased by 2/3 of the $2 billion of operating lease payments to become $24.93 billion lease-adjusted. And for Macy's, operating cash flow of $1.5 billion is increased by 2/3 of the $250 million of operating lease payments to become $1.667 billion lease-adjusted. With these analytical adjustments out of the way, we are able to calculate lease-adjusted EBIT, EBITDA, and EBITDA, three items we will need to apply the Moody's methodology. For Walmart, first, EBIT in billions of dollars, being net income plus interest plus taxes, works out, as you can see here, to $26.64 billion. EBITDA, being the same as above but with amortization added, works out to the same total since amortization for Walmart was 0. And finally, EBITDA is the same as the previous number plus depreciation, which increases to $35.61 billion for Walmart again. Turning to Macy's, EBIT works out to $1.977 billion, EBITDA to the slightly higher $2.018 billion, given that for Macy's we had $41 million of amortization, and finally EBITDA to the substantially higher $3.294 billion. We are ready to apply the Moody's methodology and begin with the 5 factors that are strictly quantitative. For Walmart, total revenues are $420 billion, which, not surprisingly, earns the company a rating of AAA for this sub-factor, as you can see from this Moody's table. For Macy's, total revenues are a far more modest $25 billion, you will recall, which only earns the company a rating of A and only just for this sub-factor. For Walmart, EBIT to average book capitalization equals $26.6 billion over $132 billion, which comes to 20.2% and barely squeezes the company into the AA rating for this sub-factor. For Macy's, EBIT to average book capitalization equals 13.4%, which earns the company a BA rating for this sub-factor. Debt to EBITDA is rated according to this table here, and for Walmart equals this ratio, which comes to 1.73, earning a rating of A, while for Macy's it equals this ratio, which comes to 3.05, earning a rating of Baa. RCF over net debt is rated according to the table here and is defined as net cash from operations less dividends adjusted upward by the principal portion of operating lease payments as explained previously and divided by adjusted net debt. For Walmart, this comes to this ugly calculation, which gives 38.1% and earns a rating of single A, while for Macy's it comes to this ugly calculation here, i.e. 18.6%, and which appears to earn the company the more modest rating of BA. In fact, and for reasons we ignore, Moody's awards Macy's a Baa rating for this factor. And finally, EBITDA over interest expense is rated according to this table here, and for Walmart equals this ratio, i.e. 9.97, earning a rating of single A, while for Macy's it equals this ratio, i.e. 3.07, earning a rating of BA for the company. We are left with the four principally qualitative subfactors. We reproduce first the simpler illustrative table for the degree of product volatility of the various retail segments. Walmart obviously fits comfortably in either of the top two categories, and in fact receives a AA, but interestingly not a AAA for this subfactor from Moody's. Macy's almost inevitably finds itself in the single B category, being virtually the classical example of a specialty apparel and department store. Both these subfactor ratings are pretty well reaffirmed when we examine the more detailed table we saw earlier that sets forth the specific criteria behind the rating categories. We pause here for a minute while you confirm to your satisfaction by examining the language for AA and single B that it accurately describes Walmart and Macy's respectively. The subfactor market concentration and company presence in that product category is also quite judgmental and is based on a ranking you might recall of the company according to the two individual criteria appearing in this diagram from Chapter 2. Here we see one of the more surprising results in our opinion. For while Walmart is undoubtedly a clear leader in its segment, we would view the sector in question as being of only medium concentration, so would have expected a single A for the company here. Yet Moody's awards the company a triple A rating which does not even appear on the diagram above. Presumably this is a simple expression of the agency's judgment that the company is extraordinarily well placed in its sector and faces very few competitive threats. For Macy's, our view would be that the company is a major player in a sector that is somewhat fragmented, apparel being mentioned in the diagram as the typical example of fragmentation, and so we would anticipate a rating of BA, which turns out to agree with Moody's opinion. Again, the verbal criteria for the subfactor are reproduced in this table appearing now, and again we pause for a few seconds to let you confirm that the very high rating for Walmart versus the BA for Macy's are broadly in line with the language in this table. We reproduced next a table for company geographic presence, which is relatively straightforward. We would have guessed that Walmart earns a AAA for this subfactor on the basis that it is a US issuer with full North American coverage and more than half its stores in at least 2 international regions. But in fact, Moody's gives it only a AA here. For Macy's, our view would have been to award a BAA, which applies to US issuers with full US coverage and meaningful presence throughout North America. But again, the rating agency slots the company one level lower, i.e. in the BA category. Next, we reproduce Moody's table for quality of execution, possibly the one requiring the greatest amount of subjective judgment. We think it would be pointless to comment on our expectation here, so simply observe that Walmart receives a AA for the subfactor from Moody's versus a BA in the case of Macy's. We summarize the subfactor ratings along with their numerical equivalents and the weighting for each in this worksheet appearing now, addressing Walmart first. We have calculated in this worksheet a final weighted average score for Walmart of 4.10, as you can see in the cell L15. For Macy's, on the next worksheet, we have similarly calculated a final weighted average factor score of 1125, as you can see again in the cell L15. We reproduce finally the Moody's table that translates the overall score into a final rating, and observe that Walmart would earn a rating of AA3 overall, while Macy's would earn a rating of BA1 overall. We remind you that other factors we discussed earlier in this module may result in a 1-notch or even 2-notch increase or reduction in the final rating Moody's would issue. And indeed, this is exactly the case for Walmart, since the final rating awarded by Moody's, reflecting the grid criteria but also the unquantifiable factors described earlier in this module, is AA2 rather than AA3. This completes this chapter 4.